with the stock market on one of its worst losing streaks in decades amid a relentless sell-off that has pushed the S&P 500 nearly 20% below its record highs. Recession risks are rising, but history shows that not all bear markets lead to long-term downturns, and stocks can often rebound over the next Y. It has been several decades since the stock market has had such a long streak of heavy losses. The Dow Jones Industrial Average recently posted its 8th down week, its longest losing streak since around the time of the Great Depression in 1932, while the S&P 500 and tech-heavy Nasdaq Composite have moved lower for 7 straight weeks, their longest losing streaks since the dot-com crash in. The last 4 times the Nasdaq posted such a streak of weekly losses of 1% or more was in 1973, 1980, 1990 and 2001, according to Bespoke data. In every instance, those streaks occurred either right before or very early into a recession. The S&P 500 has only posted a losing streak of 7 weeks or more 3 times, in 1970, 1980 and 2001, according to Nationwide's Chief of Investment Research, Hackett. Unfortunately, the index was negative over the next 12 months each time, he says. The index could tank by between 11% and 24% if the economy falls into a recession in the near-term future, major Wall Street firms have warned. Persistent inflation, another Fed policy mistake, and recession fears have unnerved investors, with the S&P 500 briefly falling into bear market territory. The widespread selling will likely only accelerate as investors will remain wary until the Fed starts to show signs that they are worried about financial conditions and that they may stop tightening so aggressively. S&P 500 briefly plunges into bear market as stocks fall for 7th week in a row.